Hi, welcome back to Academic Market Insights. As part of our series on basically how we teach some of the more important topics for professionals in the classroom, we're going to talk about put call parity. I also like to refer to it sometimes as creating synthetic positions. We were actually before, people generally talk of it before they turn the camera on. We were talking about historical synthetic positions, about how years ago the Chicago Board Options Exchange, my old employer, actually both of our old employers, if we think about it, they actually, when options were introduced in the US, only call options were allowed to be listed for the first 2.5 years or so. But people were able to create put-like payoffs using the underlying stock and call options, which, and you might be scratching your head a bit on that one, but Professor Adamiec is going to clear that one up as we go along. Before we get going, as always, if you like what we're doing, hit the thumbs up. If you want to be kept up with us doing new presentations, please hit the subscribe button. I'm going to use the old David Letterman thing because I'm feeling punchy this morning. Wake the neighbors, get the kids in front of the TV, let your dog know that we're going to talk about parity today. Maybe don't take it to that extreme. But with that, I'm going to hand it off to Dr. Adamiec. She's going to start explaining why a call is a put and a put's a call. I stole your quote.
I love it.
Okay.
It's actually, and I'll give a shout out to one of my former colleagues, Kevin Cook. I think he's over at Saks right now. But he's the one who coined the expression calls are puts and puts are calls, but sells are never buys.
Oh, see, you gave away that whole quote now.
I
I
did.
teed it up for you.
You did. And
Yeah.
I love it. And it's because it's so true. And I'm glad we're talking about this particular topic because it's one of those topics that, again, if you're taking a class, you might cover this in 15 minutes,
Mhm.
but it really shapes pricing and it really shapes the overall um, market, really.
Mhm.
So we're going to talk about parity, we're going to talk about synthetic options, and then we're going to talk about reversals and conversions. And unfortunately, in particular, reversals and conversions really aren't covered in most textbooks.
Mhm.
And they're some of the products that really drive or force prices to be in line. So when we talk about prices being in line, what we're really talking about is this idea that a call should be in line with a put. If there's not, there's going to be a pricing discrepancy. And we'll talk about why there's no pricing discrepancy, because if there is one, a trader is going to jump in, take advantage of the market discrepancy, take that profit, and by doing that, it with supply and demand, it forces those prices back in line with each other. So you do have a little bit of this idea of Adam Smith and that invisible hand, and it's really going to push those prices in line with each other. And if there's not, there's going to be a quick turnover to put those prices back together. And we're going to talk about reasons why there would be a deviation. All of these are good things that, again, if you're taking a class, you could easily skip this. Um, so this is taken from one of my favorite textbooks. I wish I would love to say that I could claim this, but this was from the Cold Book. And I'm going to date myself a little bit. When I took options a long time ago, this was, I think, the only textbook around. So John Holt hadn't written his textbook yet. But what I love about this example, and it took me a while to really get the true value of this, is we are taking two different portfolios and we are creating payoffs that are going to be exactly the same no matter what's happening in the market. The stock goes up, the stock stays the same, the stock plummets. These payoffs are going to be exactly the same. And Dr. Rowe, I'm going to put you on the spot here.
Mhm.
As a trader, do you care, really care about which position you're in if the payoff's exactly the same?
You can, but it has to do with what your goal is. Um, in the exercise assignment process. But
But
economically, no,
yeah,
you don't. You don't. I
economically,
mean, it economically you don't. They both have the exact same risk reward. But if you don't want to, the only caveat there, and we're going to leave it after I say this one more time, it just what happens at expiration.
sure.
You might that's the only thing that you might be a bit concerned about. Yeah.
But economically,
Economically, if you're going to hold this through, and also if you're thinking about exiting it early as well. But
sure,
pure economic risk reward wise, no, no. You
don't
know,
care.
you're risking maybe $2 to make $3 or something along those lines, and it would be the same with either portfolio A or portfolio C here on your slide.
Yeah, and that's such an important point that I'm going to keep referencing it because it's something to really think about. We don't really care if we're in portfolio
Mhm.
A or portfolio C. Okay, so
Yeah.
let's talk about Dr. Rowe, did you have a question?
No, I was just going to say that you we hear this phrase arbitrage free models floated
Hmm.
around all the time, and that's what we're kind of talking about is markets where there are not arbitrage opportunities or where the arbitrage trading keeps think there you go arbitrage free models where the arbitrage trading keeps very similar markets in line with each other. Sorry for jumping so far ahead on you.
No, I'm glad.
But and what you could say here maybe is that a position using the SPY ETF would give you pretty much the same sort of payoff that you could create using S&P 500 futures, which could give you the same payoff using S&P 500 index options. I mean,
And
I know there are other positions that you would need to take in there, but in general, those three markets are like a liquidity pool that keep prices in line with each other.
so I'm going to work off of your example that you just said. So
Mm-hmm.
let's say the S&P or the SPY ETF was all of a sudden much lower price than the futures or the actual SPY or the actual S&P 500.
Mm-hmm.
We would then have what would be considered an anomaly or an arbitrage opportunity because the ETF was underpriced. What a trader might do is come in and buy that ETF and then simultaneously short the other two positions.
Yep.
So as you're putting sell pressure on those other two positions, that's going to lower that price. And because you're buying that other market that's underpriced, you're putting purchasing pressure on it or creating more demand, which is going to raise prices. So that supply and demand is happening behind the scenes as traders come in and either buy or sell according to if it's overpriced or underpriced. And
Mm-hmm.
again, that invisible hand that Adam Smith talks about guiding the market through supply and demand, that's where that fits in. So, and the reason why I bring that up is you take an economics class and it doesn't seem to fit into the financial markets. We talk about supply and demand, we talk about all these things, but it's hard sometimes to really see how it works in the financial markets because we talk so much about pricing and building out models, and those two things don't necessarily equate, but they do because of this parity. And parity exists in more than just the options market. It exists in FX, in bonds, it exists everywhere in the markets. There's that natural supply and demand. And if there is a pricing anomaly, traders will take advantage of it. Okay. So let's go back to our example. And again, I just love this example. It's just one of my favorites. And if you've ever had me in class, you know that you're going to see a problem like this on the exam, and you're going to have to
Oh yeah.
solve it. You're going to have to demonstrate that the payoff is exactly the same in all three scenarios. Okay, so let's get into portfolio A. You're going to have one call option, and you're going to have a zero coupon bond that pays X, which is the strike price. And yes, it is rigged to be perfect this way. Portfolio C is going to be one put option with a share of stock, which is going to be priced at S, the stock. So at expiration, then portfolio A is going to be the max of the stock minus a strike or zero plus, oops, and there's a typo, I apologize. It's a K as opposed to an X plus X is equal to the max of the strike minus the stock or zero plus the stock price. And my argument is that these will always be true. So no matter if the stock is higher than the strike, the stock is equal to the strike, or the stock is lower than the strike. The argument is because they're replicating portfolios that this P&L will always be the same. Can't help my excitement. Can't wait to get to the next slide. Okay, now let's say the stock is greater than the strike. I feel like I'm doing my own cheers here back here. Woo.
Getting
Okay,
excited about it. Excited about the outcome.
I'm excited. So
Yeah.
our call option is going to be the max of the stock minus the strike or zero. And in this case, we know that the stock is greater than the strike, so it's going to have a value. So it's going to be the stock minus the strike. Our bond, remember it's a zero coupon bond, is going to pay off that strike value, so X. So our entire portfolio becomes the stock minus the strike plus the strike, which gives us the value of the stock. No matter what the stock is, that's the value of the portfolio. Portfolio C, remember our put option is the value of the strike minus the stock or zero. And in that case, because the stock is greater than the strike, it's going to be the max of a negative value or zero, giving us a put value of zero. The stock will be the price of the stock. So now our portfolio becomes zero plus S or S. And so in the scenario where the stock is greater than the strike, portfolio A has the value of the stock and portfolio C has the value of the stock. So Dr. Rowe, from an economic value, do we care which portfolio we're in?
No, because we end up with the stock in both
Yay!
cases. Those I
Both.
and I like how your little on the portfolio A, basically your X's are canceling each other out.
They are. I
Yeah.
actually, again, I'm really pleased with this example. And I wish I could take credit, but I cannot. I think it's Robert Kolb is the one who wrote this
Colb's.
book.
I have his books over there.
So
I
now,
taught out of it. I actually taught out of it 2 summers ago.
okay.
So
So you're familiar with this as well.
yes, I am. I am.
Now, the stock is going to be less than the strike. So our call option is the max of the stock minus the strike or zero, which then becomes the max of a negative value or zero, giving us a value of zero. Our bond is simply we get the payout of that strike value. So our portfolio A is zero plus that strike, which is equal to the strike. Now it gets interesting on the portfolio C. The put option is going to be the max of the strike minus the stock or zero. And in this case, because the strike is greater than the stock, that's the value we're going to take, not the zero. So we're going to have a put option of the strike minus the stock. Our stock is going to be S, the stock price, which gives us the portfolio value of X minus S plus S is equal to the strike price. Now, Dr. Rowe, economically speaking, do we care which portfolio
We
we're in?
we don't care. We did the same.
We get the same.
We did the
So
same. We don't care.
we don't care. So in scenario one, we got the stock. This scenario, we get the strike. So oh, I skipped over this one. Now, this one is very important. This is the at the money. Okay. And I'm glad, I think we skipped over the slide, but I'm glad we're actually doing this last. Now, the stock and the strike are exactly the same. So we get the max of the stock minus the strike or zero, which stock minus strike is zero. So it's a max of zero or zero, giving us a value of zero. Keep the bond. So we get a portfolio of zero plus the strike equals the strike. Portfolio C, We have a put option, which is the max of the strike minus the stock, or zero. So 0 minus 0, or 0, giving us a value of 0. Our stock is the value of S. So we get a portfolio of S. Dr. Rowe, is X and S the same thing?
I'm envisioning a 50 strike call.
So
So yeah.
exactly, because it is
So
at the
let's say the
money.
stock, yeah, the stock pinned at the strike price at expiration. We call that pinning.
Ex-
Yeah.
It pinned exactly at the strike
Mm.
price, which means that that strike price and the stock price are exactly the same. And if they're exactly the same, Dr. Rowe, do we care which portfolio we're in?
Nope. We made or lost
No,
the same thing.
exactly.
Mm.
It's ecstatic. So we can utilize this to really begin to manipulate and create different pricing for our options based on this. And I'm going to go back to our portfolio. So we could say that the call is then equal to the put plus the stock minus the bond. We could also say that the put is equal to the call plus the bond minus the stock. And that becomes the cruxus of
Mhm.
parity. And this is how we can start to actually price that the value of the call option or the put option. And that's going to help us derive, again, the price and then the extrinsic value or the time value of money. Okay. And we can use these to create our synthetic positions.
Absolutely. And this is years ago when I was teaching the first college course I taught at Carthage College up at Racine. I think it's in Racine. It's like at the end of one of the metro lines. Um, I I was trying to teach, synthetic positions, put call parity, et cetera, and everybody was struggling with it. I don't write on the board. If you've ever seen me try, there's a reason I don't write on the board. Uh, but what I do is I open up Microsoft Word and type things out, and I just started typing this out. And I went through, so long stock. If you want to create a long stock payoff using options, you would buy a call and short a put. They have the same. One thing that's not included on here, but is very important to the point, is the options have the same strike price and the same expiration.
Yep.
So, but long stock at a very, very basic level, I tell students, if you're going to cheat on my test and you want to sneak in a cheat sheet on put call parity, what we're going through right here will do it for you. So if you want to get a long stock type payoff, you could buy a 50 strike call and short a 50 strike put. If the stock goes down, you get hurt by that short put. If the stock goes up, you benefit from owning that call. Much like if you own the stock, you do well if the stock price goes up and the stock price goes down. The opposite of that is the short stock that you can see on there, where you short a call and buy a put. When you're short a stock, you want to profit from a price drop. And that's what you do when you own a put. Now, you can do this with calls as well. And did you hit the button? You got to hit the
There we
button.
go.
There we go. So, and you can actually, and it's just, I believe what we were just looking at, and in a roundabout way, was creating a portfolio with a stock and a put, and replicating a call payout. So if you own a stock and you own a put, um, you have limited downside in the stock price. If you when you buy a put option, if the stock starts to move below the strike price, the value at expiration, they both start to offset each other. Well, when you own a call option, remember that max of a certain value or zero. A call option cannot have a negative value to it. So losses are limited at the strike price as well when you own a call. Basically, they both look like that old school hockey stick payoff diagram. And then the opposite of it, if you were to short stock and short a put, that's the same as being short a call option. When you short a call option, some of the losses, if the stock goes up an awful lot, are offset by the premium that you take in. Some of the losses on being short the stock would be offset by the premium that you took in when you sold that put option. And it would look like that upside down hockey stick. And then finally, what I was talking about at the beginning, where when SIBO finally, when the Chicago Board of Trade, which created the Chicago Board Options Exchange, finally got approval to list options. They listed options on 16 stocks, and they only were allowed to list call options. And then a couple of years later, a little over 2 years later, the SEC approved offering put options. The idea was that they didn't want financial instruments out there trading in the market that benefited from a stock price going down. Who cares that people could short stocks, et cetera? But what traders were doing is they were doing what we see here with the long put, where they were shorting stock and buying a call. They were creating put-like payoffs, even though puts were not listed yet. So you can see the long put, just like shorting a stock and buying a call option, and which would benefit that being short the stock would benefit as the price goes down, much like you would benefit with a long put from the price going down as well. And then a short put is just the opposite, where you would buy a stock and you would short a call option. When you sell a put option, your maximum profit is the premium that you take in. When you own a stock and you sell a call option against that stock, your maximum profit is actually limited because you have that short call offsetting the long stock position at expiration as well. So for synthetic positions, if you're struggling with it, if you're watching our video because you're taking a class in it and you needed a little extra help, and I know from being a professor, people look at other professors' videos like ours and come back with questions every once in a while. This synthetic position slide right here, take a screenshot of it, because I think it is extremely helpful. And then you can see on all the payoff diagrams for each of these as well. I was in college before we even had spreadsheets. In fact, I took the first Lotus 1, 2, 3 class at Memphis State as a senior. It was an experimental class, but I knew how to program. And ended up almost being like a teaching assistant in that class, because most people had not even used spreadsheet software yet. But before that, we had to draw out the payoff diagrams by hand. I tell derivative classes, if they make me mad, I'm going to make them draw payoff diagrams by hand on tests. But generally, I don't.
If you were in my derivatives class, I actually force it. So they have to do it on the exam. I force them to do the payoff diagrams. But in my opinion, and you can correct me if you have a different one, it's one of the best ways for you to learn it.
Oh, so yeah, it definitely makes it sink in. I do multiple choice questions where I just give pictures of them and say, what does this represent? And it might be, and honestly, I might have something that looks like a long call, but the 3 choices are different synthetic positions. So you have to know which one matches up with which. Here we got. Yep, go ahead.
I'm going to interject, speak over you for just 1 second. If you are taking a derivatives class and watching this in preparation for an exam, I recommend learning how to do these by hand, taking the time to practice. If you have to use rote memorization to get it going, so then you can actually start to apply it. It is worth the time so that you can be better prepared for the exam.
All right, so I just took a note about something. So alongside, this is just the green line is the ultimate payoff that you're getting by shorting a put and buying a call. You can see, as I said, the short put loses money as the stock price goes down. The long call makes money as the stock price goes up. And the premium that you would pay for the long call and take in for the short put would offset each other to create a payoff at expiration that is the same as buying the stock. Then when you go ahead, when you short a stock, you'll see the colors flip a little bit on the next slide. There we go. You can see we're buying a put, which benefits as the price goes down. We're short a call, which gets hit as the price goes up. And this is the same as a short stock position. On the next one, we can kind of fly through these a little bit. This is where it gets a little bit more difficult. And what we're looking at here is we're looking at the long call payoff, again, the green line. But which can be created as a combination of buying that put option and owning the stock. And the thing that used to drive me bonkers about having to draw these by hand is trying to figure out what was offsetting what at different inflection points. But you can see that the long stock and the long put, I like, when you draw these by hand, you're doing them in pencil. You're
Hmm.
not doing them in color. I think in color, I probably should have used colored pencils back then. That would have helped. No, I would
Yep.
try to draw them as dashes and then a solid line, but it would, and make sure you bring a ruler to class as well. Um, so on the short call side, flip that over. Yeah, you can see that the short stock and the short put, they are offsetting each other on the left side of this chart as the price of the stock goes down. Whereas when we start to go up, we do actually will we can incur I'm on the second floor of my house right now. That green line, remember imaginary lines that went forever, they put the arrow on them. I imagine that one going down to the first floor and across the street to the church. uh,
Buddy.
then on the long put, you can see that a long put, the green payoff here, is being off. I'm more interested in the risk side than the actual payoff side. And again, on the upside, you can see that owning the call and having a short position in the stock, those two are offsetting each other.
Mhm.
And on the left side, we actually are not getting a benefit from the call anymore, or we're not getting, I would say, hurt by the call in this case. But we are benefiting from the stock price moving lower. And then finally, on that short put, see where those guys offset each other once again, which is a short put. If we sell a put option, our goal, if we're doing this speculatively, is for the stock price to close above the strike price. And in this case, if the stock price is above the strike price, owning the stock and having a short call position are offsetting each other. And your profit's going to be equal to the premium that you took in when you did this trade.
Okay, our
Yeah.
synthetics. Okay, so reversals and conversions. Um, and this is something that I feel if you were to take or join a prop trading firm, this is something that they're going to really emphasize to you. It's not necessarily as heavily emphasized in textbooks. So a lot of lectures will completely skip this, but this again really forces the idea of what parity is, which is where the synthetics come in, which is where replicating portfolios come in, and what forces prices to be in line. So we've already talked about arbitrage and how there could be discrepancies in different prices and how supply and demand forces those prices that are underpriced to be increased because there's higher demand pressure on purchasing, and prices that are overpriced, there's going to be a price decline because there's going to be a sell-off. So our buying power is going to be offset because people are selling off those products. Okay, so we talk a lot about hedges, and I want to talk a little bit about some of the more technical problems that come about from hedging and setting up some of these trades. So we in our academic world, everything lines up exactly perfect. So, for example, in the last scenario we did when we're looking at the replicating portfolios, Dr. Rowe made a comment about if it's exactly a pin. So, meaning that the stock and the strike are exactly perfect. So, in most of our examples, when we talk about these things, we're looking at perfect prices. Another issue we might have is some of the timing. So, as Dr. Rowe, when we're talking about whether or not a trader cares about the payoff, one of the things he talked about was, well, you don't know what time, the date that you purchase some of these things. So, in all of our examples, we're assuming that we purchase all of the assets for all of our synthetic positions at the exact same time. And that might not be the case. And we'll talk a little bit later about in another series about some other trades where that may or may not make sense based on when you've purchased an underlying asset. Uh, And again, I'm so glad Dr. Rowe talked about all these things when we're talking about the whether or not you care about it. Our
Mhm.
hedger might want to get out of the product before expiration.
Yeah.
And that's true for a lot of these positions that some of these positions are put on and then are unrolled before actual expiration. So that becomes a challenge for some of our hedges. And I think this is important. And
It's
again,
very
something
important.
that's really not discussed. Why in the world would there possibly be price discrepancies? We keep hammering in this idea of the invisible hand and supply and demand prices to be in line with each other. Well, why? Why in the world might there be differences? Well, one of the things that's fun about the financial markets is that we have news and things happen. And so these things can easily become out of line with each other. For example, a company has an expected dividend, and then surprise, dividend is either higher or lower than the expectations. And that's going to have a change then. Yes, Dr. Rowe.
Oh no, finish up on dividends, and I'm going to tell you something you don't know.
No, tell me.
Okay.
You can't dangle that.
Well,
Tell me.
I one of the guess what one of probably the fastest growing listed derivative product over in Europe is over the past few years. It's futures on Euro Stocks 50 dividends. They have
Oh,
introduced dividend, and it's a way to manage that risk right there, and actually creates an arbitrage. It can create, I'm not going to say an arbitrage opportunity, but a way to speculate if you think the market is mispricing dividends. Just looking at, I just pulled up a quote on a different screen of dividend futures. Right now, there are easily a 500,000 contracts open in a 500,000 contracts of open interest for dividend futures over in Europe. And these things really caught on during COVID because there were cash flow concerns and there were concerns as to whether what companies' dividend policies were going to be. So
sure.
there's actually an arbitrage free way to anticipate dividends as well relative to the other derivative markets. And they're so, and my big point here is there's a good thing it's number one on this list because it really is probably one of the most significant things that can get in there and have people think that the underlying derivatives for a stock or even an index are slightly mispriced because they have a different outlook on dividends.
And it's funny. This I, I put this together maybe back in 2009. So
Mm-hmm.
right after the big financial crisis, right? And I think, if I remember correctly from that long ago, I put dividends in here because I thought it would be a quick point with number four, volatility being the big driver. And it's so you can see number two, interest rates can change. And back when in 2009, interest rates were pretty flat for a long time.
Yeah.
It wasn't a real, it was one of those things, oh yeah, interest rates could change, but nobody really thought about it or put,
We almost took them out of the curriculum at SIBO.
I fully believe it. You know, if
And when we had, and the OIC also had this discussion, and my response was, once if we take it out, interest rates are going to start to go up, and we're going to have to put it right back in. So
and
we didn't do that, but there was a period of time that interest rates really didn't mean much. But and we're going to talk about this in a future video. You can
Mhm.
get a pretty good idea of what the future interest rate is going to be using the derivative market.
Sure,
And now you can get a pretty good idea of what people think dividends are going to be using derivative markets in some countries as well. Uh,
absolutely. And supply and demand can change.
mhm,
So part of this is due to popularity for different trades,
mhm.
for different products that are going to be used. We're talking another video about structured products, and there's more demand for some of these different types of derivatives that you can embed into these products. So there's some of that as well. And again, I don't really like the word popularity, but really that's what it is.
Yeah.
What are we interested in? What is the market interested in trading in?
Mhm.
And some products will go out of vogue and will either close or will continue and be a flat growth product. Okay. So that could easily happen as well. And then volatility. And we're going to have an entire session devoted to
Oh,
volatility because it's fun.
it's fun, and it's
And
it's my topic.
well, and it's your definitely your topic, and we've talked about this before. My background teaching at a prop shop in options,
Mhm.
everything was driven by volatility because
Yeah.
that's where you got price movements. We didn't think about options in the terms of the price. We thought about options in the term of the volatility. So, from when I was thinking about putting this lecture together, volatility was the one item that I really wanted to highlight, not the dividend. So I'm so glad we had that discussion
Yeah.
because volatility is what really can drive. And if you have a spike in volatility, prices hopefully will follow in line as quickly, but they might not. And if they don't, there's going to be an arbitrage opportunity.
And another topic that we're going to hit on that relates to that is liquidity.
Yes.
One of the reasons we get excess volatility is not all the market makers are required to be quoting all the time. And when we get excess volatility, they just kind of they get out of the way.
Yeah.
They
Actually
totally
wrote
get
that
out of the way.
down. We need to, that is
Yeah.
a very important and another one of those topics that maybe 20 seconds in a graduate class. Okay, so uh, we're going to look at conversions and reversals. Let's use an example that we've got an underlying price of 102, we've got a call price of 510, a put price of 285, and a strike of 100. So we're going to make the argument that our call minus our price should be equal to our underlying minus the strike. And if we think back to our replicating portfolios, we can think of the strike as at zero price bond. Okay, so we're just removing some of the complexities of valuing some of those bonds. We're not including the risk-free. We're assuming this is at expiration, so we're skipping forward to that part. So then we have a situation where it is the call price minus the put price, which will be 225, but our underlying minus the strike is going to be $2. So, Dr. Rowe, are those the same?
They are not the same. There's
Now,
a there's an opportunity to if you're into looking around and trying to pick up coins each day, there's an opportunity to pick up a quarter here.
and would a trader be interested in picking up that quarter?
If it is if that 25 cents, we're not including the time value of money in here, et cetera, but if that 25 cents overcomes the cost of trading, yes.
Absolutely.
And you do incorporate when you're doing these things in a more complex manner, we do incorporate how much borrowing costs might be. That's why the bond has come up a couple of times in the discussion today. But if it costs less than 25 cents to execute this trade, based on commissions plus any cost of funds that you may have, absolutely. And
Yeah.
there are arbitrages that you can put on where you receive cash and you earn interest off of it as well. But in a very straight, if in a costless trading environment, absolutely, you want to pick up that 25 cents.
And I like that we're starting to talk about this. In this example, we're looking at cash flows. So how are we going to execute this? Well, if you're looking at trying to pick up the discrepancy, we're going to purchase the stock, we're going to sell the call, we're going to purchase the put, and then we're going to exercise. Okay.
Mm-hmm.
Um, and so let's talk about the cash flow. When we purchase the stock and we're long, we actually have a negative cash flow. I think this is an important point, particularly if you are a student and this is the first time you're really thinking about it. When you buy something, we I think students have this idea that it becomes a positive because you own the asset, but from a cash standpoint, it's actually a negative. So we have $102 out the door. We sold that call option, so we are going to gain $5.10. We have a put purchase of $2.85. We are going to exercise our option, which means then we have a $100 gain. So we have a profit of 25 cents. And this is our conversion. So if we will continue to do this trade as again, long as it's profitable above trading costs until those prices are going to be locked in and they're going to be the same again. Okay, so a conversion is going to be the purchase of the underlying, and we're going to offset it by the sale of that synthetic position, what Dr. Rowe was speaking about earlier. We're going to buy the stock, we're going to buy the put, and sell the call. Then we are long the underlying, we're short the synthetic underlying, which becomes a long underlying, short call, and long put. And this is incorporated because if you are taking an exam, this might be another way to take a picture of this one because this will be a good, easy cheat sheet. If you are in a situation of how do I price this? Here's really quick how the mechanics of what we're actually looking at and doing. Okay. So let's take a quick look at a reversal, the opposite. So in this case, we're going to say the underlying is 102, the strike is 100, so same as before. Now the call is 490 and the put is $3.05. So we have $4.90 minus 305, which gives us 185, compared to 102 minus 100 at 2. Dr. Rowe, are these the same?
No,
No.
$1.85 does not equal $2.
No, every single time. No, no,
Yeah.
no. So this time around, let's look at what the cash flow for a reversal would be. We are going to sell the underlying, which means we are short the stock. But when we are short the stock, we collect that $102 right now. Woohoo!
Mhm.
So we have a positive cash flow of 102. We're going to purchase the call option. So we have a negative cash flow of 490. We're going to sell the put, which means we have a gain of $3.05. We're going to have the exercise assignment,
Mhm.
which of $100, which gives us a 15 cents riskless reward. Hopefully, this is greater than trading costs. So our reversal is then going to be the sale of the underlying, and it's going to be offset by that synthetic. So again, when you're thinking about the synthetics, where do these come in line? These come in line quite a bit, and these are hopefully forcing those prices back in line because a trader will go ahead and execute as long as it's above trading costs. So that 15 cents, they'll do that trade all day long because it's worthwhile to them. So they're going to sell the stock, sell the put, and buy the call. It's short the underlying, long the synthetic underlying, or short the underlying, long the call, and short the put. And those are our conversions and reversals. If
Awesome.
you want to see more of us, we have a website, academicmarketinsights.com. If you like this video, please hit like and please subscribe. We appreciate you staying through the end. If you have constructive feedback, we are very open to it. Also, if you're going through this video and say, you know what, I'd really like to hear more about conversions. Let us know. We are happy
Yeah.
to develop an entire video devoted to something that you're interested. Our goal is to provide that extra bit of educational information for students and for people interested in options in general. With that, we say thank you and goodbye.